That also helps the employer because they're not paying FICA tax on it either. Okay, under ERISA, the plan has to be in writing and it has to be communicated to employees. It has to be established for the exclusive benefit of employees and their beneficiaries. It can't be just for the executives. It's got to satisfy things like eligibility, like the vesting that we just talked about, and funding. And it's also got to not favor officers and highly compensated employees. And one of the things that you see, or that was happening before ERISA came in, was that the pension plans were only available to the highly comped. So now it has to have those eligibility criteria. You also see things like discrimination testing that come into play, making sure that it's not giving greater benefits to the higher paid employees than to the lower paid employees. Those kinds of things also come into play. In defined benefit plans, the difference here is that there's a lot of mathematical formulas going on. Defined benefit plans are what normally are called pension plans. And they basically say, this is the benefit that I calculate for you based on our plan's structure that you'll receive when you reach age 50, 55, 62, 65, whatever it is. They use things like mortality tables to figure out how long they need to pay you. So if I retire at age 62, and let's say I'm a male, and they expect me to live until approximately 75, and I make this much money, and I expect to get a raise of 3% every year, then when I retire, I should get $200 a month for the next 12 years. It's that mathematical. Defined benefit pension plans are very mathematical. So because they're doing all this actuarial probability projecting, it's all mathematical theory. That money sits in a pool. It doesn't have your name on it. It just sits in a pool until you get paid. Then it becomes your money. Then it becomes put into your account. Money in a defined benefit plan is guaranteed by the Pension Benefit Guarantee Corporation. I had to look at the letters. And this is basically insurance. Your employer pays premium to the PBGC to protect that money. And then it's sort of an insurance plan to protect it, because you've got companies that go bankrupt. And so there's a limit to how much of that money disappears. If I have a benefit that's worth $120,000, I think PBGC guarantees up to $100,000, but I don't really remember for sure. I think it's $100,000. Kind of like the FDIC insurance we've been seeing, where they've been increasing the limits. Okay? And there are lots of different kinds of pension plans. Now, it has been true that in the past that 401ks have started to overtake defined benefit plans. And it's really kind of, started to gravitate towards 55, 45, or 60, 40, kind of moving towards the 401k side of the scheme of things. But the 401k side is taking a hard hit right now. Even though pensions are still investments, there's still big pools of money that are invested, but the 401ks are really a little bit more vulnerable in this type of environment. So defined benefit plans express a promise. They're entirely funded by the employer. I don't think I've ever run into one that actually has employee, well, I take that back. Government agencies may have employee contributions. In fact, I believe the state of North Carolina requires an employee contribution. So government agencies can require employee contributions. But most of the time, at least specifically if it's in the private sector, it's going to be employer funded. And one of the things that you find is that the employer has to calculate how much money they put in. So they have to project the liability of the plan to come up with how much money I need to put in the bank. And they have to do that every year. They have to look at their population. They have to look at how long people have been employed, how long they expect them to work, what their turnover rate is. Because you don't want to put money in for somebody if your turnover rate says that about every 3 years I'm going to lose 20%. You take that number off. You back it out. Say, okay, I've still got to fund 80% of these guys. Everybody who gets past 3 years has to be funded. So that's part of that mathematical picture. And now you're beginning, I bet, at this point, as we've gotten to about halfway through the presentation, you see how the finance comes in, how the risk management is everywhere. So this is a very financially driven portion of HR, very risk driven. And then you have different kinds of payments that you can get through a pension plan. The lifetime pays you, let's say it's going to pay me, if I retire at age 65, it's going to pay me $300 a month until the day I die. regardless of when that is, whether it's 66 or 95. It's going to pay me that $300 a month. Joint survivor annuity says it'll pay me, the participant, until I decease, and then it'll pay my spouse. And usually that changes, that reduces that $300 to maybe $225, because now you're involving two people. A period certain says it's going to pay me for 10 years, and that's it. So if you think you're going to live longer than 10 years, you got to have something else in the background to pick up the slack. But you get more money. Maybe you get $400 a month because you're only get it for 10 years. And then lump sum is you can take all the money out. But because the lump sum is tied to when that distribution happens, it's tied to interest rates. It's tied to, I think the interest rate on treasury bills is one of the calculations. So it's very tied to what your current environment is like when you get that money. Because remember, all of this was theoretical, you know? So it's when you get the money that the interest rate comes into play. And people a lot of times are really upset about that whenever the interest rate is not in their favor. Because they think that, you know, their statements have been saying this all along, but then this year, the one that the calculation is happening in, is not a good year. So that's part of the pension process. Defined contribution plans really talk about how much money am I going to put in the front end. So they don't tell you what your benefit is going to be on the back end. They don't give you any idea of what that benefit is going to be. It's all based on how much money is put in and how well the money does in the market or whatever investments are made. So now you can see where, because investments are being made by employees, sometimes with very little direction from the employer, because the employer is afraid to give you direction on where to invest your money. They're afraid of the liability, that you'll come back and say, I made a bad decision because you taught me how to do this and I didn't make a good decision. So they won't touch it. But I bet you money they'll start touching it, because they already have a fiduciary responsibility to help you make good decisions. It's just not really written in a law anywhere yet. But you think it's going to come down the pipe. This is my prediction. It's going to come down the pipe. Employers are going to, because already you're seeing the change. Employers are starting to offer a little more education. So your 401ks, your 403bs go for your state agencies like your teachers and your hospitals. And then you've got money purchase plans, profit sharing plans. These are all different types of defined contribution where it's all about the money going in. And you might put in $3,000, but you might only be able to get out $2,000 if the economy goes down and the stock market tanks and your investments tank. Or it might, you know, just soar and you get out $5. It just really kind of depends. And again, we've got employer and employee contributions are available in defined contribution plans. So you can have either or you might have all employer, or you might have all employee. It depends on how the plan is built. You have the responsibility laying on the employee to make investment decisions. The contributions are tax deferred. They may have loan revisions where you can get a loan out of a 401k. It doesn't exist in every 401k or every 403b or whatever the plan is, but it very, very seldom exists in a pension plan. Almost never. I don't know if I've ever run into that, but it will in a defined contribution plan. And they hold increased risk for the employee because they have employees have less experience making investment decisions, but they're given all the responsibility to make the decisions for defined contribution. Whereas on the DB side, you've got actuaries and you've got finance people, and all those guys are making the investment decisions. So the risk is not so much, and the benefit is defined, so the risk is not so much at the feet of the employee. Okay, we want to take a break? Or do you want to finish this slide?
Let's finish the next 3 slides, and then we'll be to healthcare, and we'll take a break before we get into healthcare, because that's a big one.
Yeah, and I couldn't remember where it actually came, so, okay. We'll go through these really quick.
And this particular slide, for some reason, the words did not copy, so you might want to jot this down, okay?
Oh, you mean it didn't copy on your...
No, it didn't
that's
come out.
weird.
Yeah, it is weird, and
It's the way the slide is built, and I had trouble with it when I was working with it. Okay, IRAs, generally you're going to find, these are individual retirement accounts, you're generally going to find them in the bank, but you may find them in an employer situation. But most of the time, you're going to find these. There's also Roth IRAs that are very similar. The structure of a Roth IRA is just a little bit different from a traditional IRA. But again, these are most often offered by banks, but you can find some within an employer environment. SEPs for self-employed individuals, it's a kind of a simple pension plan for somebody who's self-employed that allows them to tax defer some of their earnings. Same thing for the simple for employees with contributions. So if I was a small business with employees and I wanted to have a fairly simplistic pension plan or some type of retirement plan where my employees could contribute to it as well, then I would have a simple plan, which is a simple plan. 403B plans go for your state agencies like we talked about. Your tax deferred contributions can be there. Your employer can make contributions into this. They're usually used with hospitals and educational teachers are often in 403B plans. TIA CREF, you see the commercials for TIA CREF all the time, or TIA CREF? Those are 403Bs going out to your teachers and stuff. I think they may offer other retirement vehicles, but they're very, very big in teachers and hospitals. Employees of the states, a lot of times they will have 457 plans, which often are plans that they have a loose structure and they may have many different vendors underneath them that are providing employees the ability to tax defer into some type of investment vehicle. So 457s are generally almost like a 401k, but they're used a lot by state agencies and tax exempt organizations. Let me know when you're done with the words or if anybody has any questions.
I have a question.
Yeah.
At 401ks, if you pay, so you're paying into your 401k,
Mm-hmm.
and if you, like you said, some of them you can take a loan on or whatever, why is it so difficult and scrutinized for you to take a loan out on your 401k?
The reasoning is that they want you to keep the money in there so that you don't spend all the money and you have money for retirement. So that that's the idea, to not make it easy, so that you really have to work for that loan and you don't take it arbitrarily or frivolously. So that's the reasoning behind it.
How, with the economy the way it is, I've heard a lot of people say their 401k is like half what it was. What, I thought that was money that you're putting in there. Is it like a stock market or?
It is. You're investing it, and I mean, a lot of mutual funds are used. It might be in stock markets. It might be a lot of different things, but they're investment vehicles that go up and down.
So
Yeah.
I didn't even realize that until I heard people start talking. My dad said this is like half. And he's
Oh,
been
yeah.
with the company for.
And can you imagine being, 63, and suddenly this happens, and all of your retirement nest egg is almost gone? These people this is going to change the workforce over the next 10 years because people are not going to have the money to retire. We've been talking about talent shortages for the last 10 years, but that talent shortage is going to change because these people can't afford to retire. The money's gone.
But if the stock market goes back up, will it?
It won't go back up that fast. It'll go up.
Because like my daddy, he's been in the company for 40 years. He's like close to 60. So
Yeah. Yeah, it'll go back up, but it will take time to rebuild that nest egg. And what you'll find is these people are either working 2 jobs or they're going into a different field. Maybe if they want to move into something that's less physical, maybe they need to change the kind of work that they do or something like that. So the whole mixture of who's working and who's not working is going to change. The baby boomers are going to stay longer than we thought.
So where is the best place to try to, invest your money?
In your mattress.
Well, it's, there are so many different ways that you can invest it, and what I would recommend is, because there are so many different options, I would recommend that you get smart about what the money market is like. And I would, and one of the reasons that I started doing this was, Nikki mentioned in my introduction that I have a consulting business. This is a startup process. I've been at it for about 3 years. As a matter of fact, when I got my degree, I started in a community college just like this. And now I'm independent because I went independent because I was working with an organization and they decided to eliminate my job. And I thought, well, I can either take the shot and go back and find another job on the inside, or I can see if I can create my own work and learn how to find work on my own. And then it won't happen to me again. Well, that's the path I chose to take. It is not an easy path, but I have found it to be really rewarding. But what I had to do was learn money, because I was used to being an HR person inside. I was used to having work funneled to me. You know, I was used to having my day planned and emails hitting me, you know, right and left and things to do and deliverables I was supposed to be responsible for and meetings to go. And now suddenly I had all this time on my hand and I had to create my own work life. And I had to manage my money because I didn't have a paycheck guaranteed coming in anymore. That paycheck was based on the work that I did to find it. That's why when I was joking at the beginning of the class that my passion now is to make money. The passion is to get the cash flow normalized so that it's not going like this all the time, which I have found through my education is normal for a company that's as young as mine is. But it's not any fun. It's not something I recommend. But it's a normal part of the process. So what I had to do was start paying attention to what the economic news is. Start learning, and in the beginning, you know, it was kind of, I didn't quite get it, you know, but the more I listened and the more I paid attention, the more I began to understand how it works. And it's been probably 2-3 years that I've just been watching it and absorbing it, and I read a lot about it, and I try to understand it, and then gradually you begin to get familiar with the terms, with the way the money moves. You start learning how people make investment decisions. I'm not anywhere near people, you know, that make some of these decisions. I'm not trying to say that, but I understand it better, you know. And so, because you got to decide, you know, what's your risk tolerance, you know, how much do you want to go for it? How much time do you have to invest? Can you sort of ride the ebb and flow of the market? Because the market's still going to do this. Hopefully it's not going to do this anymore, or this, you know, but it's still going to fluctuate. So you have to decide, you know, I'm young, I can take a shot, I can put my money here, I really think these companies are strong and they're going to go after, you know, they're going to grow and they're going to be good, or you can decide to be conservative, go after the big companies like the IBMs and the Microsofts, but even those are showing decreased money. So you see, if you learn about money, then you can learn how to protect yourself, how to plan for your future. You can't eliminate all of the risk, but at least you don't get hit quite so blind. You know, like whenever I lost my job, suddenly it was just like, now what do I do? You know, and I was lucky. I was very, very lucky because they continued to work with me for a while. So that's what I'd recommend. Education. Yeah. Did you have a question?
Is now, you said that you're still in the young stages of it, is now the time to try to do something like that on your own? If you already have a plan and you already have a business proposal and all of that stuff, is now the time to try to do it by yourself? Or branch out on your own?
I'd say 2 things to that. There's probably never a good time because there's always going to be challenges that you have to deal with. It's kind of like you have to decide for yourself how much you can deal with, you know. For example, I don't know if I would have tried to do it when my kids were young, when my daughter was young. That would have been too much instability. But if I had, you know, if I had a husband or a boyfriend or somebody who had my back, and I do, he can't pay all the bills on his own, but he can float me for a little while, you know, because sometimes the money's slow getting there. So I have that ability to have somebody to back me up. So you have to kind of gauge what's your position. And a lot of it has to do with, you know, how bad do you want it?
Right.
You know, if you're willing to work really hard at it, and it takes years. It does. Not because, I mean, you might be a great success story that happens really quickly, but it's not because that you're not doing the right thing, but because you have to learn a whole different way of thinking about work. You know what I mean? And it takes time. Some of it is you have to take the shot and learn and fail and, okay, I really screwed that up. You know, I took one of those shots in 2008. It cost me a lot of money. And I really lost it, but you learn.
If you look through history, many of our best inventions and our entrepreneurs really became successful during the difficult times in the history of our country. And there's kind of a philosophy that I live by that you can go back to with that. And a friend of mine sent me a postcard during a downtime in my life once, and I looked at the postcard and it had a picture of the sky on it with lots of bright stars. And I went, well, that's kind of nice, flipped it over, and it says, hang in there, girl, you can do it. But I looked back to the other side, and the real message was in that photograph. And Think about, during the day when you're walking around outside, are the stars there? They still exist, don't they? But can you see them? No. But when it gets dark, you can see the stars. Well, when things get bad, like they are in this country now, that's when the entrepreneurs come out and we can see them and they start to glow and they start to shine. That's when managers inside companies become creative and become innovative, and all of a sudden they shine. So during the darkest hours, I mean, even days that maybe Christy thought she couldn't make it, or you want to do your own business and you think you just can't make it another day, if you think about this as a dark time, and this is now when I really need to get going because I want my light to shine, you're going to be successful. If you lay back, you just become one of those dull stars that we can't see. So a lot depends upon your attitude, how you approach things, what kind of stick-to-itiveness you have, and the support system that you build. Okay?
And that doesn't mean you can't do it if you don't have a support system. It just means it's harder. But the biggest thing you need is discipline. And it's something you probably have to learn on the job a little bit, because suddenly you're completely responsible for how productive that day is. Nobody's telling you you need to go do this, you need to go do that. Nobody's banging on your door to get your attention. Nobody's, got a deadline that they're giving to you. You have to give your deadlines to yourself. And you have to say, I need to finish this, And I can tell you from experience, in the beginning I was okay. But I had days when the internet was just on all day. Where did they go? In the early days. And gradually I got stronger and stronger and stronger and stronger at hitting the deadline, going after it, and making the meetings. And I had one woman who had been in business for 18 years tell me that she made a decision, and early on that she said, this is my axiom I live by, no shy moments. Because you got to learn how to sell it. You got to sell yourself. You got to sell yourself on it every day, because some days it'll just tanks. It's a bad day. And you just write it off. And I'm done for break.
No, we're not. We got 2 more slides real quick.
Oh, I forgot. Sorry.
Non-qualified deferred
sorry, I forgot.
compensation plans.
Non-qualified plans. Sorry, see, I got a passion for it. I get off on this every because it's fun. It's fun. Non-qualified plans are when the company is trying to give benefits to the execs. They're basically, the qualified plans are capped under ERISA. There's like a maximum of maybe $45,000 in contributions that can be put into any kind of retirement plan, and they add them all together and say you can't put more in than $45,000, no matter how many plans you're operating under ERISA. But for an executive, that might not be as much of a benefit. That might cap them out early. If the formula is 6% of salary, but it maxes out at a salary of about $100,000 and an exec's making $150,000, then they're not getting as much of a benefit as the others. And of course, you always want to make the highly comped happy, right? So they use the non-qual plans to come in and save the day. They're not covered under ERISA. They're not required to meet any of those rules. Sometimes the money is put in a pool. Most of the time, it sort of exists on paper until the executive executes the right. Okay? And quadros. Quadros are whenever there is a benefit, usually a retirement benefit, where a ex-spouse normally or a beneficiary has a right to a portion of that benefit. Let's suppose you get divorced and you were married for 20 years, and that pension that your husband or your wife has was created during the life of the marriage. You were employed with that employer, they got the money, they're vested in the account. So you get divorced, you have a right to a portion of that pension because you were married for that length of time. North Carolina is a community property state, right? So you have a right to that. And you file a quadro that says, I have a claim against this benefit. If you don't file the quadro, then the employer cannot protect your portion of the account. They don't know. It should be part of your settlement process. If you get into anything like that, your lawyer will bring it up. Then that goes on to file with either the employer or the administrator of the plan or whoever it is. And they keep that on file to make sure that when that distribution happens, that that payment that's portioned to you also gets made. Okay? Now we can take a break, right?
Yes, now we can take a break. Let's do just 10 minutes since we're breaking late, okay? And when we come back, we'll start talking about health plans. I'm not familiar enough with this building to know if there are soda or snack machines in it anywhere, are there? Okay, so if you desperately want something, you'll need to walk over to Medlin, of course, which is right next door downstairs, okay? Yes, as you go out the door, turn right. Restrooms are right down the hall.
Right. Yeah, sick. He did last, I mean, it's bad economy, got and he tried to borrow against it.
Are you bored?
They got so much, and he sent Dr. Bills, because we didn't want to go too far.
I thought that they would show,
He said the high hardship, that he wanted a hardship drop. He showed, I don't know how many documents, I don't know how many, he still, to this day, it's on.
who was the company administering that?
I don't think so. I don't think, I'm not, yes, down in one city.
Yeah.
I'm not sure. I don't think it's them. I'm trying to remember what the heading on the paper was. I don't think it's them.
I'm sure.
He tried to take a hardship and they would not give it to him.
I
In fact,
always,
he submitted it 2 different times because it kept saying that it had.
that sounds a little,
That's what I have.